Welcome to our final session today, the Investor VC session. My name is Melissa Bula-McGinnis with W Marketplace, the co-host of today's event, and I am your tech lead for the session. I'd like to introduce you to our session moderator, Kendra Kuo from the U.S. Commercial Service. Kendra.
Thank you, Melissa. Well, congratulations to everyone. Thank you for making it to the end of the day, or maybe you're like me and you've been popping in and out of sessions throughout the day. Either way, I'm thrilled that you decided to stick around and listen to our panelists today. We'll be talking about working with investors and venture capital. My name is Kendra Kuo, and I'm the director of the U.S. Commercial Service Office in Grand Rapids, Michigan. And it's my pleasure to see so many of my colleagues on the screen today. One of the best parts about my job is working with strong female leaders throughout the country and throughout the world in our 75 US offices and over 75 offices in foreign countries and US consulates and embassies abroad. And then the next best part about working with my job is meeting so many great business leaders and working with small businesses. So although I've only recently met our panelists today, I've been really impressed with what they have to share, and I think you'll agree with me that they have some great insights to share. So thank you for joining us. It's my honor to introduce to you Madeline Haydon, and she's the CEO and founder of Nutpods. And also joining us today is Ben Lee. He's the managing director at CircleUp Partners. Thank you for joining us. Madeline, let's get started with you. Could you tell us a little bit about yourself and about your company?
Sure. My name is Madeline Haydon. I'm the founder and CEO of Greengrass Foods, and our first brand is Nutpods. It's a line of plant-based coffee creamers and barista milks. I started it in 2013. I'm from Seattle. Love a good cup of coffee, but I'm lactose intolerant. So I just wanted to get away from all the processed creamers and powdered non-dairy creamers that you see on the marketplace. And so I started my company with no background in the food and beverage space. I actually came from the blood banking industry and medical devices. And so created it in my kitchen, started with a Kickstarter campaign because I wanted proof of concept and actual startup funds. And then we ended up launching in grocery stores in the Seattle area. Then a month later on Amazon, where we became just #1 best-selling, #1 new release. And we're still the best-selling brand online. And now you can find us nationwide across all grocery stores such as Walmart, Target, Costco, Kroger, and you'll see our creamers in the refrigerated set as well as the shelf stable. So we're going to be talking about all sorts of fun things in food and beverage and raising money, and it's quite a journey.
Great, thank you so much. And Ben, can you introduce yourself and tell us a little bit about working with CircleUp?
Yeah, thanks, Kendra. So I'm Ben Lee. I'm one of the managing directors at CircleUp Growth Partners. We are a venture fund focused on the consumer product space. We invest at the early stages when a brand is already in market and has some traction, but in the early days of their growth. And so we kind of describe that as $1 to $20 million in revenue for consumer brands. Really trying to solve the gap for early stage funding within the consumer ecosystem. CircleUp as an organization has a few different business lines, one around data to help early stage businesses, as well as a lending arm that provides short-term loans for consumer products companies. But really the mission was to support entrepreneurs in an industry that lacked a lot of financial resources in the past. We are based here in Silicon Valley, and we're founded here, and we saw the amount of funding that was going toward a lot of the textile businesses at the early days, and thought that consumer products companies had an equally attractive opportunity to provide them with different financing and resources. And so we've been investing in early stage consumer brands for the last 5 years. I've been an investor in the consumer space for about the last 15, and fortunate to be partnered with Madeline as one of the entrepreneurs that we've worked with.
Oh, that's fantastic. Yeah, I saw that on your website, you range anywhere from 10,000 to 10 million in programs. What's your typical client look like?
Yeah, so I mean, across the two different programs that we have the equity arm, which is more traditional venture capital, will be a slightly on the higher end, where we'll call it $1 to $20 million in revenue, and our typical investments in those companies are anywhere from $1 to $5 million. And then on the credit side of the business, which is lending against assets a business might have, will typically can work with brands that are doing as little as a few $100,000 in revenue, and able to lend as little as $10,000 or $20,000, all the way up to businesses that are doing, 30, 40, $50 million in revenue, and can lend them, multiple millions of dollars again against the assets that they have.
Okay, that's interesting. Thank you. So Madeline, I'm wondering for you, what did it look like for your company to decide that you were at a position where you needed to look for additional funding, or what motivated you to find CircleUp?
Man, it is rough out there, Kendra. I mean, especially when you're in my position. Number one, I am a female founder, person of color, pregnant with my second daughter and new to this industry. So to be honest, it was very hard. I mean, I was not bankable when we started. And so I went the traditional way of a lot of entrepreneurs, where you start with your family and friends, and you go through your life savings, and you go through your 401k. And that was quite a moment with my husband when I said, we've got one more crack at this, and we have just enough in my 401k. And he said, don't do it. And so, but sometimes you have to believe in yourself. And so we had gone through promissory notes with people that had extra capital that weren't ready to invest in, equity yet, because we were a startup. We didn't know if we had anything going yet. And then we also went to a convertible note. So that convertible note triggers with a qualified round. And so with that, we went out and we sought institutional funding. And I think one of the things that women have as an additional barrier is that oftentimes, our career path is a little bit different. So we don't have necessarily the same inroads, to the investment communities. It's not like there's a Rolodex to be able to find out, oh, okay, I need angel investors, super angels, family offices that invest in the food and beverage space and startup stage. So it was very hard to get going in networking. Where do we find investors and at the right stage for us? And so that's where I think a lot of the trade groups that are in particular areas can help you network. And so, but that's an important part, and it's underrated, but it's so critical.
Good point. Yes. So Ben, can you tell me a little bit about how important it is for you to create that relationship with your clients, and what's it been like working with Nutpods?
Yeah, I mean, for us, again, I speak mostly from the lens of the venture investing side of things. And so we do have very long-term relationships with the entrepreneurs that we partner with. A typical investment for us can be 3, 4, 5, even 7+ years at times. And so it's really important for us to get to know the entrepreneur, and a lot of times are getting to know them sometimes over the span of years before we actually partner with them. Madeline was someone we were fortunate. We actually, in a former function that we had at CircleUp, we actually supported companies in those fundraise efforts rather than investing ourselves directly. And Madeline was one of the early brands that we partnered with to support with some fundraising efforts. And I got to know her over several years before we started making our own investments. And so it built a good relationship and a collaborative relationship there. And when the opportunity arose for us to invest directly, was very familiar with Madeline, was familiar with her business, had seen the success and the momentum that she had created in the brand. And so for us to be able to make a relatively quick decision to be able to partner with these entrepreneurs, that relationship and that trust and kind of seeing the history of the work is an important part of what we do, given how long-term that relationship really is.
Collaboration and taking the time to plan for the long term. That makes sense. Makes a lot of sense. How about for you, Madeline? How did you know that they were a right partner or a good fit for you?
I think part of it, you'll hear oftentimes that you need to be very selective with who you partner with, because once you issue equity, it's very difficult to get them out of your organization. So, being able to find an investor where they had a great reputation in the space, food and beverage in our case, where they had a proven track record. CircleUp has been behind some great brands like Halo Top. And so, and being able to see what value that they add. A lot of people have money, right? That's what they're doing. They're lending their money, they're lending their expertise. But I really felt comfortable from my interactions with CircleUp and seeing them just help and provide introductions, even when they had really, nothing to gain from just helping me out. And so those are the things that really matter to me. You'll sometimes find investor groups where they don't give you the time of the day until you're relevant in their stage. And I get that, because time is important to all of us. But it also matters when you go and you pick your partner, where if they weren't willing to speak to you at a trade show, if they weren't willing to help you with an introduction, then to me, it's not really somebody that I wanted to partner with. And so we had great interactions with CircleUp.
Thanks for describing that process. So Ben, could you tell me a little bit more about how you select the companies? Do you require them to present a formal business plan, or what kind of things are you looking for before you make that decision to partner with a company?
Yeah, I wouldn't say that's a formal business plan. I find that particularly at the early stages of kind of building a business and fundraising, it's almost an unnecessary level of detail and production to go through a full business plan. What I would say, though, is that the components of what goes into a business plan are really important. And so that often is presented in a short presentation, a PowerPoint deck, where an entrepreneur is able to describe what the problem they're solving is, why the product that they have is different, and why it'll be important for a lot of consumers, and why they are the right team to go after that problem. And I think that it is, again, that is a core question that we ask as investors, is oftentimes, why is this a product that's differentiated in a way that matters to a large number of consumers? And so being able to answer that question in a discussion and being able to show that you've got the understanding of the space, you've got the right experience and the right skill set to go attack it, which doesn't mean that you necessarily come from that exact industry. As you heard from Madeline, she didn't come from the food and beverage world, but she understood the pain point that she was trying to solve as the customer herself, and she and she had researched what the market opportunity was, and was able to speak about, in a quantitative and qualitative way, how she was going to go about attacking that market, more so than just having a rough idea of it. I think that that level of detail around why you're doing what you're doing and how you're going to do it are important parts to be able to present. And sometimes that comes across in a business plan. Sometimes that comes across in a phone call, candidly. Like, it could be any form, but really, as long as you've got the components of being able to tell the story on what you're building and why you're building it, is kind of what is that initial thing to get us really interested. I would say that there is a process that is relatively standard around looking at company financials, and so wanting to have your financials in order. It does not have to be audited by any means, but it does have to be kind of in good order, and being able to have projections for what you think the business can do over the next several years, and having an ask for how you want, like, what you're looking to raise. Someone who says, I just need funding, versus someone who has an idea of, I want this amount to support these initiatives, is a very different discussion.
So if they come with a specific ask, you're more likely inclined to believe them, that they know what they're talking about, and
exactly
give them what they want.
It's a reflection of, they understand what the levers are to grow their business.
I think it's also really important, Kendra, that an entrepreneur knows how much they need to get to the next level of proof point. And so even if you could, and there are some people who could do it, But even if you could raise $5 million in one go, you're really diluting yourself at such a early stage versus being able to raise 800,000 to get to retail, and expand into a new product line or add a new SKU. And then you need like maybe 1.2 million after that. And so being able to have these tranches, and anybody who has raised money will tell you it is a painful process. It's soul bearing, and you really have to get through a lot of rejection that feels very personal. They're either saying no to you, they're saying no to your business, they're saying no to your product, they're saying no to your strategy. But a lot of the times what I've learned is that they're actually not saying no. They might be saying not yet. Like, I am an investor in the food and beverage space, but you have to get north of $5 million in revenue. I might be an investor here, but I'm still learning my way, or I'm more at the investor level. That's an individual, angel investor. And so really being able to kind of pinpoint how much you need to raise, how much you're willing to dilute yourself, because there will be probably more rounds than you think if you're successful. And I think Ben touched upon something that's really critical, which is your team. They are banking on your product and they're banking on your strategies, but they're also banking on the entrepreneur and the team. And as you grow bigger, the team becomes more and more important. But I often say in different podcasts, I could have had the same product launched at the same time, but if I had a different starting team or a founding team, we might not be in the same spot, because that initial group of teammates that you put together for your brand, those are the ones that run the hardest over hills and through walls for you. And it's really important that you put together a great team as your founding team.
Yeah, that's so important. Thank you for mentioning that. I think, creating that culture and creating that vision where the people will go through the wall for you and work that next level. I also liked what you said about kind of putting together different steps of what you want for what stages you want. It gives you kind of sets your own metrics so that you could get to that next level of funding if you want to go there. So thank you. Did you use a business plan to sell yourself to Ben, or did you come together with a deck? What kinds of things would you recommend that companies do to organize themselves?
You will need to have a deck, an investment deck. And so some of the things that Ben had talked about, funny enough, we actually launched in 2015. And this was 2 years after our Kickstarter campaign. So it took us 2 years to get to market with our formula, because we were doing a lot of things that weren't on the marketplace before. And as I said, we had run through all of the personal money, all the friends and family, all the 401ks, all the life savings. And so on a lark, I had entered the Seattle U's business competition where I got my MBA. And the first prize was $10,000. I'm like, okay, that will at least give us $10,000 more dollars. And so I wrote a business plan, went there with my founding team there. We ended up taking third prize, but it was really a great experience to go through, because you do have to articulate, about your business. And that is a very useful step. Nobody really believes the projections that you have. So Ben, it's a check the box, right? Where it's like, you have to have projections that you're thinking about what your growth pace is going to be. And everybody thinks they're going to have a hockey stick. But I think that all of the other components about how are we going to manufacture, how are we going to go and distribute our product, how are we going to have a unique selling proposition, how do we fit in the competitive landscape? Those are things that were very important to do. So maybe not required, but highly advised.
Yeah, I think the twist I would put on that is just candidly from the investor's standpoint, a business plan is quite dense and can be quite long, and just from a pure ability to digest it quickly, it can be a more involved process. And so the reality is not too dissimilar from when people are applying to jobs and you have a very short time when people are reviewing resumes to catch the recruiter's eye. It is, an investor is not going to spend 20-30 minutes on every business plan that comes in. And so the benefit of I totally agree with Madeline that the process of going through a business plan is a helpful part of distilling down strategy, of distilling down the level of detail and understanding that you need to understand, to kind of grasp about the business, to really show that you are thoughtful about what you're going to do to actually build a brand and build a business. But the way it's presented in a more of a PowerPoint presentation is a more effective way to get that message across quickly than in a very dense business plan.
And a lot of times you'll have literally just a one-page teaser that will give a quick overview. And then maybe, you know, at the initial meeting, you might provide them a 3-page PowerPoint with a little bit more detail. But it's a good analogy, Ben, about a resume.
Okay, I see we have some questions coming up in the chat. I'm going to ask you a couple more questions and then we'll head over to those from the audience. Madeline, what other advice do you have to give to women-owned businesses on how to better prepare themselves for funding?
You know, I think number one is just really don't be afraid to ask questions. And I think sometimes we get afraid that when we're starting our new venture that we're going to confirm what we don't know, but you're not going to get the answers that you need if you're afraid to ask them. And sometimes when you meet somebody who is an industry advisor or an industry expert, or you meet someone at a trade show, or you meet someone at a conference, you know, you want to latch on to them. You're like, Kendra, will you be on my advisor? You know, on my board of advisors. And it's like, I just met you and I wish you really well. So, but that's still an opportunity to ask them a question. And if you'd like, then you can say, you know, Ben, I'd love to keep in touch with you. Can I connect with you on LinkedIn? And then you can follow up. Ben, it was great to meet you so much. You know, I was thinking about, how do you think about this? And so you can still benefit by asking questions of people that are experts and people that have the knowledge that you're looking for, without full board being like, you know, will you be on my board of advisors? And so every piece, it was like a jigsaw puzzle to me. And people I met, you know, I wouldn't be afraid to ask questions. I think number two, it is really important to understand the different stages of investors. You know, angels, super angels, family offices, venture, private equity. And one of the things that we had talked about previously is that for female founded businesses, only 4% of venture capital goes towards female founded businesses. And 2%, you know, according to PitchBook, go to private equity. They behave very differently. And it's important to know how their strategies differ, because it depends on how they will behave a little bit. You know, venture will cut slightly smaller checks than private equity, but they're more risk tolerant. They're also taking more bets on a portfolio. So say, you know, 8 to 10 groups. Private equity will be more risk adverse. They will write bigger checks further along in your business, but their tolerance for failures is a lot lower. And so being able to understand how the different investors are structured will help you understand about what are their priorities and what they're looking for.
That's very helpful. Thank you.
I
have one last question for you, Ben, and then we'll open it up to the chat. So, you know, with the economy and everything going crazy right now, do you have any advice, or what kinds of things do you share with your clients on pricing strategies or things of that nature?
Madeline's been a part of a lot of these similar conversations over the last year. It's just the economy's done a lot of really interesting, like there's been very tumultuous in a lot of ways. You know, first there was all the supply chain challenges and kind of increasing input costs. And so what we saw a lot of brands do, and oftentimes successfully, and this is what is ultimately the consumer seeing at shelf, is prices are increasing. And it's a reality that the brands themselves have to do it to be able to maintain the profit margins that they need to you know, continue to manufacture the products that they are selling and to the consumers at the end of the day. And so it leads into the inflation that you're seeing at shelf. At the same time, you were seeing on the investing side of things, you know, I would say 2019, 2020, even 2021 was a very frothy time when there was lots of investment dollars going into early stage brands. a lot of people who were trying to find the next buzzy startup to put money into. And for a lot of categories, that has slowed down dramatically in 2022. And so from a business standpoint, really focusing on fundamentals of the business, focusing on margins, focusing on collecting your accounts receivable in a timely manner, managing inventory levels so that you're not sitting on too much inventory, which a lot of retailers and brands today are facing that challenge because they did try to order in advance because of a lot of supply chain issues and now are sitting on that product. And so it's just the balance of focus on the fundamentals and managing cash, candidate at the end of the day, because that is the one thing where you have some more control over your own cash balances, about how you manage it, about how quickly you, and if that comes at the expense of slightly slower growth, that's okay. And it's really about living to fight another day and waiting out this cycle and being able to control where you go for the next 6-12 months, and not be forced in some situation where you have to go out and find a way to finance the business. It's better to be in more of a sustained mode for the next 6-12 months, and then kind of wait for that right opportunity to go back into a mode where you might be able to raise more capital, where you might have a new opportunity pop up that accelerates growth unexpectedly. And so really it's, like I said, focusing on those fundamentals and controlling what you can control.
I have to chime in here with one thing that I really think has gotten a little bit lost with all of the dollars that are pouring in. It is a big achievement to be able to close a round, no doubt about it. Raising money is hard. At the same time, raising money is not the goal. Raising money is a byproduct of having a financially sound business that is able to sustain itself. If you are running at a loss and you have to raise money every 9 months or every 9 to 12 months, there's a point where you have to take a look at what are the financial foundations that you are building. Because even if you're raising money, how are you going to find, an exit for your company? And so take a look at the public markets right now. There's been a lot of brands that have gone to market and they don't have sustainable gross margins. And so after a while, it's reflected in the stock market. And after a while, you don't want to get to the G round, to the Series G round. And so I think that while it is important to raise money and have access to capital and be able to grow your business to scale, also recognize with some perspective that that's not the goal. And it's hard because every once in a while, you read someone like, wow, they raised at a valuation of like $500 million. Good for them. We on the other hand, we've been profitable for about 3 years now. And so for us to be able to build a profitable business with sustainable margins through COVID, through all the supply chain, that's something that we're immensely proud of because it allows us to grow in a healthy way where we are going to be positioned one day to exit. And that's actually the goal, is to have a business that can be built and scale and exits, because Ben and CircleUp, they don't get their returns out by investing in a family legacy business. And this was never built to be a legacy business. It was built to scale so we could help a lot of people looking for healthy plant-based options, around the nation. And so with that, you need to have scale.
Great insights. Thank you. A question from the chat for you is, can you please address the equity you leveraged to get funding?
So I think we're a privately held company and we're also private equity backed. So what I will share is that my goal at the end of the day is to own about 30% of the company at the very end. So you have to backtrack. How many times do you think you'll need to raise money at what valuation? And so I think that's another pitfall that a lot of early stage entrepreneurs maybe overlook, is that when you raise the big dollars, because there's a lot of money pouring into the consumer space, you're also diluting yourself at the most expensive stage of your business, because your valuation, your enterprise value, will be the lowest in your very first round. Then when you start to grow and, you know, have more enterprise value. And so, you know, one of the things that's absolutely critical for me, may not be for other people, was that I wanted to control my business and the decisions. And you can't do that if you raise money too quickly and then all of a sudden you are in a minority position for your company. So being able to pace how much you raise and how much dilution you are going to give in return for that is a really important part of your strategy. A lot of people think, oh, I'm just going to get like a bank line of credit. That's great, but you have to reach profitability first. And a lot of the times that doesn't come till several years after you start. Same thing with factoring. You know, you might be able to find a factoring company that, say, for example, Kendra, you know, you buy from me for $1. Ben is going to give me the funds to pay off that invoice. So I have the funds and I don't have to wait the net 30, net 40 days. And then he gets a percentage of that. But it still is, you know, it still is another step that you need to have in order to grow. So being able to have different tools for the different stage that you're at is really important to controlling your cash. Cash is king. No.
Cash is king. The president of the first company that I worked at, was a trade association that I worked for. He those were his parting words to my husband on the way out the door. Cash flow is key. We just kind of looked at him because we were, you know, young 20s. We're like, what is he talking about? Now we fully get it. And I'm not a business owner.
When you have to produce, market, sell, you know, and then wait 40 days to be paid, it can get painful.
Get that cash. Yeah.
Yeah.
So have you received any formal coaching along this process, or who have been your mentors throughout?
So you know, I have to give due credit to my CFO. He's also my husband. And so he had a background in investment banking. And so he helped me along the way. You know, he didn't join our company until I think it was year 4. He was supporting our family. And so he couldn't join because I was a full-time volunteer for Nutpods the first 3 years. But I think I give him a lot of credit in helping shape, you know, where we are in terms of being able to raise money and think about that equity and think about the cash flow and all of that. I also would really advise women to take a look at forming a board of advisors for you. So an advisory board. So people that, you know, you might give them some options and then they'll give you advice. The reason why you want to form an advisory board is twofold. Number one, I could probably call up Ben on an ad hoc. I met him at a seminar. I kept in touch with him at LinkedIn, but at some point he's just going to give me, you know, as best he can, thoughtful advice, but it may or may not be as well thought out of as when I give him some options. So it's like, you know, be a little bit more thoughtful, help me get to market. And I would love to give you some options and hopefully, you know, they'll be worth more and more as we grow together. And it also allows me to hold him accountable. So if he's not, you know, if he's not being a good advisor, if he's flaky or if he's blowing me off, then, you know, he has to still earn those options. And so that's one way to access people that you will need to have. I think the other way to do that is that when you go to raise money, in my case, I'm new to the industry. I've never been a CEO before. CircleUp knows that. And so they're going to be looking at who is advising me. Am I just making these decisions without a lot of experience? No, I have, you know, reputed people in the different functional areas helping guide my route to market. And so that's another benefit of having an advisory board.
A follow-up to that, somebody, when you mentioned give Ben some options or give your advisor some options, what do you mean? Do you mean like financial options, or you just mean like, should I choose path A or choose path B, or what do you mean by that?
I see. Yes. They are options for equity in the company. And so they are financial incentives.
Okay, great. Thank you. Ben, you talked a little bit about, you know, what are the kind of the startup process and what you look for in a company, but could you talk a little bit more about how you structure a deal? Is there a formula you go by? What might the numbers look like for a deal versus no deal? And what are the requirements or criteria that CircleUp goes by?
So there's you can get into a huge discussion around how to properly structure a transaction. What I would say is for us as equity investors, we're investing in, equity being essentially the last money out of a company. You have to pay off all your debts, you have to pay off all your loans, and then whatever the company is worth, that's what the equity holders all split. And so we are purchasing a portion of the equity in a company. And how you determine that is it's kind of math at the end of the day around how much are you investing and at what valuation. And so that determines what percentage of the company you're buying. But the devil's in the details around how you come to, again, the amount that you invest is a little bit of a function of what the company wants to do with the money, kind of what their plans are, how they plan to spend it to get the business to that next level of growth. And then secondly, it's the valuation. And valuation is very much a little bit art, a little bit science. There is a formula in the sense that people are typically using some sort of multiple. So that might be a multiple of your sales. It might be a multiple of your profits. It might be a multiple of, even within sales, it might be your actual last 12 months revenue. It might be your projected revenue. It might be your last 3 months run rate. And there's a variety of different metrics that you can use, but at the end of the day, you apply certain ranges of multiples to those numbers to come up to a rough sense of what the valuation range is. One way to think about it, though, is that as an investor, we are also targeting, certain levels of returns. We want to be able to make, 5 times our investment over the span of 5 years. And so that can help you then back into, if we think this business can be, this size in 5 years, that might imply a certain valuation at that endpoint. And so it kind of caps what you might be able to pay today in terms of a valuation. And so again, there are formulas that inform it, but the art really comes down to what do we think the opportunity is? How big is the upside? What do we think this business really looks like in 5, 6, 7 years when there is an opportunity to maybe sell the business to someone else? And that can inform how we think about what the current value of the business is today, rather than just being a straight formula of 3 times revenue. And so it's all those things. You kind of look at all those different methods to triangulate around how to value a company, and then that ends up being mostly just math around how much am I investing at that valuation, and then so that's the percentage of the company that I now am an owner of. There's a lot of other details that you can go into around the structure, and there are different terms and things.
It's hard to hit it all in a 45-minute webinar breakout session.
The short answer is
you've had a whole career to do this, but exactly. Yeah, now tell us all your knowledge right now.
I think it's hard, Kendra, because I think there might be some women here where they need access to grow their business, but they are looking for a lifestyle business. They want to be able to pass this down to their children. And, that makes it hard for institutional investors to invest in, because how do they get their money back out? So being able to take a look at different financial tools to help you with the growth that you need, access to capital, but being able to find the right partner is also an important part of the strategy and how you grow your business. Growing your business, growing your customers, growing your capital.
It comes down to, like Madeline was saying, there needs to be a match. Different types of funding sources have different things that they are looking for. And so being able to match your business to what they're looking for is going to be a super important part of it. For us as a venture investor, we are heavily focused on growth. And so a company that is steady and very profitable, while it can be an amazing business, for us as a venture investor is less of a fit for what we're mostly focused on. And so even though it's an incredible business, we would probably tell the entrepreneur, it's just not the right fit for us to partner with you, because we are very focused on growth. And so when we're looking at a company, we'll look at how fast have they grown prior to engaging with us, and what do we think is the opportunity for how much growth can there be in the future. And then to Madeline's point, we also are looking for, is this the type of business that we could then find another investor that would want to buy our stake in this business. And so again, there's some businesses where there wouldn't necessarily be a clear buyer. And so regardless of whether it's a great business or not, if there's no buyer for it, it becomes tough for us as more of an institutional investor where we have time limits, where we need to return money to other investors. If it just doesn't match up, it becomes tough regardless of how well a business is performing. And the flip side, if you're very slow, you might just need some loans, whether that's from a bank, whether it's from another type of lender, whether it be from an individual who is willing to lend you money. They might be looking for something that's pretty safe, lower returns, but they know they'll get paid back in 2 or 3 years with a little bit of return, and that might work really well for them. And so just matching up the profile of your business, what you want to do long term, and the type of investor is a super important part of the conversation as you grow. And I know all of this is very nuanced. And so to Madeline's point, I think it's really important just to talk to a lot of people, talk to other entrepreneurs, talk to advisors, just be willing to ask a lot of questions and, risk looking a little bit silly, looking a little bit uninformed, because at the end of the day, at least within the consumer products world, I think everyone is very well-intentioned in wanting to support and wanting to help educate and inform and make connections. And so the people who are in the earlier stages of learning about something as specific as fundraising, there's a lot of people who want to support and try to help along the way. So I think it's the willingness to look a little silly and just ask the question is a big part.
It goes, you go much farther. You just got to get over your ego a little bit. And
That's right.
yeah. And I know that we have colleagues with the SBA who are willing to help too, and maybe introduce you to other entrepreneurs. And then I think there's like a SCORE group, that's the senior retired people who can also give their expertise. And so just feel free to reach out to either people in the commercial service or SBA to see who they know in their network that might be able to help you along the way. I think we've got time for 2 last questions, and then we're going to turn it back to the main session for closing remarks. Melissa, is there anything that you think we should be hitting that I've missed? I think there's one last question about like percentages of equity. You talked about that a little bit, but how do you decide how much to give, when, and what does it look like?
So I think the question that I saw in the chat box, it referred to the advisory board, and the answer that I would say to that is it depends on the stage. If you're brand new like we were, man, there was like a lot to figure out, and so you gave a little bit more, depending on like, are you going to give me a half an hour once a month? Are you going to give me an hour once a month? And so being able to take a look at what stage you're at, and then how active of an board, of a advisory board are they willing to commit to you, then that informs like how much you will be able to give them, versus if you're further along but you just need kind of like tweakings along the way, you're giving less options but still giving a commitment of like, high touch, low touch, medium touch in terms of what their time permits. I would recommend as a resource, Y Combinator has a great template in which to talk about forming advisory board, and then what is the range that you want to grant.
Okay, great. Thank you so much. Last question, and then we're going to close out. Shark Tank, love it or hate it?
Who are you
No
asking?
Whoever wants to answer.
I'm grateful. I'm grateful to be on the other side of women that have been able to raise money on the venture and private equity. The reason why I participate in places like this and venues like this is because I want to make it easier for female founders and female-led organizations access capital. And if someone from me that, was recruiting for blood drives with cookies and juice and stickers can go ahead and successfully do this, I hope to inspire and show that other women can do that too. So there's a lot of grit along the way, but your determination will take you far.
Thank you, Madeline. And thank you, Ben, for your time and your leadership and for sharing your stories. It means the world to the people on this webinar, and I've learned so much from both of you. This concludes our breakout session. We're now going to turn it over to Susan, our event organizer, for a few closing remarks. Thank you so much and have a great day.
You all.
Thank you.
Wow. Thank you so much to everybody. I don't remember the last time that I sat glued to my laptop for 5 hours watching a webinar. I attended every session today, and it was amazing to interact with everybody in the chat. This was just so incredibly inspiring. I just want to do a couple of quick thank yous to, first of all, to Melissa from the W Marketplace for doing an amazing job with all of moving everybody in and out and handling questions in the chat. And it was just so smooth and seamless. And thank you so much, Melissa, for probably having the hardest job today. So thank you for that. I also want to thank our organizing partners. The U.S. Commercial Service has just been an amazing partner in putting together this event. They did a lot of the heavy lifting. They recruited all the moderators. Thank you to our moderators. Thank you so much for bringing in our high-level speakers from the U.S. International Trade Administration and from the Small Business Administration. Thank you to all of the lenders and financing services who joined us today. Thank you for your incredibly valuable time, and especially to the women entrepreneurs who joined and shared their experience. There is nothing that is more helpful when you're trying to run your own business than hearing from other people who have successfully navigated a really difficult thing, like finding funding and capital. So thank you so much to all of those women who joined us. Thank you to all of the women who joined us today. It's hard to take time out of running your business to come to something like this. And we so appreciate it. You were so active in the chat. It was so fun to interact with everybody. Thank you so much. You know, our goal for this webinar was to provide a broad range of funding and financing options. And our hope is that you walked away with inspiration, and that you walked away with maybe some new connections, some new ideas for how you can grow your business. Because as we were talking about in the chat, we need more women CEOs, and we need more women running business in this country. So we are so thrilled that you all joined us today. You know, you all heard a little bit about the W Marketplace earlier from my co-founder, Kate Eisler, in our earlier session. Please reach out if you have any questions about the W Marketplace. Of course, we'd all love everybody to go onto the site, wmarketplace.com, and shop and support other women entrepreneurs. So every time you make a purchase, you're making a decision about where you want to put your money. And the other thing that I just wanted to hit on, because I think it was so great from our last session, is find your fit. Talk to everyone and be vulnerable about what you don't know. That is how you're going to grow your business. Talk to everyone, find the right fit for you, and be vulnerable about what you don't know. Just going to say that again. So at this time, I'm going to turn it back over to Melissa for just a couple of more points on how we're going to close this out and how you'll get the information from this session sent to you. So again, thank you so much for joining us. And we are hoping to see you in future sessions or on the W Marketplace. Thanks again.
Thank you so much, Susan.